I am very excited to have on the Goldstein on Gelt show, Jim Lange. He's got over 30 years experience as a CPA and an estate planning attorney. Jim, one of the things that I deal with a lot is that people get inheritances, and in particular, they live in Israel, and they get an inheritance from someone who lived or lives in America, or lived, I guess, because they're getting an inheritance, who had an IRA. People make huge mistakes sometimes when they get the IRA. Could you just tell us what are some of the mistakes that people make when getting this kind of inheritance?
Well, the first rule of thumb, Doug, is to think conceptually, which is don't pay taxes now, pay taxes later.
Amen, brother.
This actually applies while you are working and after you're retired, and even after you die, or in the case that you're talking about, is when people inherit an IRA. Let's just use $1 million as a nice round number. If you inherit $1 million, and remember, nobody has paid U.S. income taxes on that money, and it doesn't matter where the person is in the world, they are going to have to, even the beneficiary is going to have to pay income taxes on that money. Now, if they don't do it intelligently, and let's say that they pay income taxes or they don't plan right and they have to pay income taxes on the $1 million, let's say they have to write a check for $400,000 to the IRS, now they only have $600,000 left to reinvest. A much better plan would be to take something called the minimum required distribution of the inherited IRA. And that's how much is the government mandated amount that you must withdraw from an inherited IRA. And that's basically based on your life expectancy. So let's say you have a life expectancy of, say, 40 years. Then you would have to take 40 as the divisor, divide it into the $1 million, and you'd have to take out 2.5%. So if you think about it, instead of writing a check to the IRS for $400,000 and only having $600,000 left, you are paying tax of, say, $22,000. So you basically have virtually the entire amount left for reinvestment. And you continue that pattern, and that is called the Stretch IRA. We want people to pay income taxes later, even with inherited money.
Yeah, I think that's the amazing thing that people have to realize, that the IRA it's just a type of account. It's a vehicle in which people put their money. So in that account, you might have stocks or bonds or mutual funds. Inside the account, you have so many different options, but the moment you start to pull the money out, that's when the taxes are due. And Jim, what I think you're describing, the Stretch IRA, is a great opportunity for someone to actually enable him to continue benefiting from the tax-deferred status his whole life if he got that IRA, let's say, from a parent.
Yes, they could. And even better is if the beneficiary is very young, perhaps a grandchild, in which case they can stretch or to some extent defer income taxes, not for maybe 30 years of life expectancy, but maybe 60 or 70 years. So the idea, and this is current law that we're talking about, the idea that beneficiaries can defer the income taxes on the vast majority of the inherited IRA is one of the critical planning points. And if you run the numbers, the difference between paying taxes now and paying taxes later on, let's say, $1 million over the lifetime of the beneficiary might be $1 million. That is, if you do it right, towards the end of the beneficiary's life, they will have $1 million. If they do it wrong, they will have nothing. So this is not an inconsequential decision.
Sure. No, I think it's very critical. One of the things I'll tell you that people in Israel have a problem with is a lot of times what I see in my day job as a financial advisor is that someone receives an inheritance, let's say from a parent in America, the kid lives in Israel, and then he calls up the brokerage firm in America and he says, I am the inheritor of this IRA. I'd like to keep it in an IRA. I'd like to do a Stretch IRA, just like I heard Jim Lange say on the Goldstein on Gelt show. I'd like to do that. Can you just set it up for me? And then the U.S. brokerage firm, because today they're very strict about having clients with addresses overseas, the U.S. brokerage firm says, I'm sorry, we're not allowed to open an IRA for you. You'll just have to cash out the whole thing today. And that's a huge problem. And it's also not really true, because maybe it is true that firm won't open an IRA for you, but others will. And Jim, based on what you're saying, the value at the end of the day to you could be huge. It's really worth taking the time to figure out how to open the U.S. IRA, even if you live overseas.
Well, and not only that, not only does the U.S. representative have to set the account up, and you mentioned set up an IRA, but technically, so let's say that, of course, Jews usually don't name their children after themselves and have junior and second and third.
It's okay. Well,
so usually
for educational purposes only, right?
Right. So I usually use Joe Jr. So Joe Sr. dies and leaves his IRA to Joe Jr. And Joe Jr., let's say he goes to a broker, and let's even he says to the broker, I inherited money from my dad. I want you to set it up as an inherited IRA. And the broker says, okay, the new name of the account is Joe Jr. IRA. By doing that, the broker's made a horrendous mistake that violates one of the rules, and now Joe Jr. must pay income taxes on the entire inherited IRA within 5 years of Joe Sr.'s death. What should have happened is the broker should have titled the account Inherited IRA of Joe Sr. for the benefit of Joe Jr. So just that difference is really critical, because the difference between using, let's call it the right language, and I'm going to say it again for anybody who's taking notes, because, by the way, this is botched much more often than it's done right. Inherited IRA of name of the person who died for the benefit of the person who inherits. That will enable the beneficiary to continue the stretch or the deferred income taxes on the inherited IRA.
Does that apply, by the way, going from a husband to a wife, or only from a parent to a child?
No, that will apply to any non-spousal heir that might be a child or a grandchild or a partner or a cousin or somebody else. With a surviving spouse, the surviving spouse, there's a bunch of complicated rules, but the simple thing to do is to do what's called a trustee-to-trustee transfer, and that way the money is transferred from, let's say, the deceased husband's name to the name of the spouse, and there you have a different set of rules, because in that case, the surviving spouse will not have to take any minimum required distributions until he or she is 70. So it's the spousal beneficiary is treated pretty much like the IRA of the original owner. That is, there's no minimum required distribution until 70, and then at 70, minimum required distributions kick in. Now, of course, that has to be done right also, but that, frankly, is routinely done correctly, where the stretch IRA for the non-spouse is routinely botched.
Right. Yeah. I think that the takeaway for this is that if you are in this situation and you don't remember all the details that Jim has been talking to us about, make sure you work with someone who has experience in this and double check, because once you mess it up, it's not like you can go back 3 years later and say, oh yeah, I forgot and I coded it wrong. Could you fix it? Because once it's set up, Jim, that's it?
Well, the problem, of course, is you are exposing yourself to the IRS, and the IRS, if you think about it, with the new $10.8 million exclusion available to husband and wife for federal estate tax, and the government needing as much money as they can get, they are looking after income tax. And frankly, it's easier to tax dead people than alive people, so they're looking for these kinds of opportunities.
Jim, I want to step away from the IRA question for a moment, because it overlaps with an area that a lot of people talk about. They say, all this complication with an IRA, who needs it? Why don't I just take the money and put it into an annuity? Because there it's tax-free, right? Well, is that a recommendation that you give to people?
I better watch myself, because I'm not a big fan of the traditional commercial annuities. They tend to have very high fees. They tend to not be all that tax favorable as you might think. So let's say that you go out and buy an annuity for $100,000. Yes, it is true, the growth on that annuity will grow tax deferred, but then when you take money out, you have to take it out first on a taxable basis, meaning that you're paying up taxes on the growth. And then when you die with the annuity, all the growth on the annuity is taxable. My biggest objection probably is that I believe that, and against, people have different ideas, but I actually like well-diversified portfolios where you're actually investing in businesses or index funds or mutual funds. So I tend to not be a huge fan of the traditional commercial annuities.
Mm-hmm. And I don't think it's a replacement at all for an IRA, and it's certainly not something that should be put or bought inside of an IRA. Would you agree with that?
I would agree with that. I think one of the advantages of an annuity is at least the growth is tax deferred. Well, in an IRA, your investment is tax deferred anyway. So I think the only time people really end up buying an annuity in the IRA is when the broker wants to sell the annuity because, frankly, he makes a pretty nice commission on it, and the client doesn't have money outside the IRA. So let's say your client has $1 million in his IRA and nothing else, and the broker wants to sell a $100,000 annuity. Well, the only source of money to pay for the annuity is inside the IRA. So even though it might not be favorable for the client, that's often what is sold.
Yeah, unfortunately, I've seen that happen too. It's something people have to watch out for. But, Jim, something people can actually watch for regularly is how they can follow you, because unfortunately, we are out of time today. So in the last few seconds, just tell us, how can people follow you and follow your work?
Well, if people go to my website, which is paytaxeslater.com, again, paytaxeslater.com, there's a lot of resources, including a book on IRAs and retirement plans. But it's always a pleasure to be with you, and I hope the information I've given will help at least one of your clients or listeners.
Okay, I hope so. Jim Lange, thanks so much for taking the time.
Thank you.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Check out all of Doug's money ideas at goldsteinongelt.com. Doug specializes in helping people who live outside the United States handle their U.S. investment accounts. If you have a question that you would like answered on the air or off, contact Doug at his website or send him an email to doug@profile-financial.com.